The new income tax law on real estate that limits costs allowable for tax purposes is affecting real estate developers, particularly those that rely on bank loans to support their developments.
If they could consider interest rates also as allowable expenses or finance costs, I think it would make a huge difference to property investors. But when you do the numbers at the end of the day, it's beginning to become debatable as to whether that is really a good investment to be getting involved in right now, given the outgoings and the expenses and the taxation regimes that are being levied on real estate, and if that really bodes well for the sector.
Previously, all expenses were deductible before taxes, but now only 50% of expenses is allowed for non-individual developers, while individual developers only have threshold of 2.82 million before tax. Tax analysts argue that perhaps the taxman has a point if you do the math.
Looking at the individual taxpayer with a gross rental income of 10 million shillings, if we are to say disregard the threshold, which would be a deduction anyway, but if we are to disregard it and say we are going to tax the 10 million shillings at 12%, means the individual taxpayer will be paying tax of 1.2 million shillings. So what that means is that the individual taxpayer is left with a balance of 8.8 million shillings. Wouldn't that be sufficient for one to also pay the interest? Because by the time you have gross rental income of 10 million shillings, it's unlikely that you went and got a loan that is much higher than that, which would not service a debt. And really the same also applies for a non-individual taxpayer.
Seemingly okay, the new tax regime could start to bite developers still servicing loans, which could reduce their business margins significantly at a time when occupancy is struggling to recover. Joan Salmon, NTV Business.